Gina, is this the moment we're going to start to see a shakeout in equities from a yield at 2.7%?
Okay, so it's really hard to say that the bond market is really going to disrupt the path of equities when you have earnings estimate revision as rapid as we have. Just over the last month, to put this into perspective, estimates have gone up for 2018 earnings per share on the S&P 500. Estimates have gone up 4%. That is 8 times the pace of your average estimate revision of the last 5 years. So certainly we think this is about earnings. Now that said, you might be going into a little bit of soft patch on earnings. And it's very rare to say you're going into a soft patch when tech stocks are reporting. But because tech companies already had an extraordinarily low tax rate, their estimate revisions may be constrained going forward relative to some of the rest of the index where the tax boost is so much more significant. So I do think this week is going to be really interesting and really telling for the stock market, because can these big tech companies produce major upward estimate revision like the rest of the index already to kind of keep pace? And that's your big question for this week.
And also it feels like, Chad, that a lot of the earnings revisions were just that, earnings. They weren't sales revisions too.
No, but still, you're getting a positive boost within sales. You have a strong tailwind. You have economic vitality here in the United States. You actually have GDP growth within the Eurozone, followed by strong credit growth there. So it's real economic activity, as well as China still is growing at a 6.5% clip. So we're expecting strong revenue growth for 2018 within NASDAQ companies of roughly about 10% and earnings growth of roughly about 15%. That's pretty powerful. Now, we're overweight equities. We're neutral when it comes to growth over value at this point. But valuations, and we have to keep this in mind, are somewhat toppy. Market cap to GDP hasn't been this high since 2000. So we have to be somewhat more pragmatic going out over the course of the next, say, Q3, Q4, as the Federal Reserve raises interest rates and the ECB becomes a little bit more hawkish.
James, what wins? Is it going to be earnings, or is it going to be the yield grinding higher for the equity market?
Well, so far it's been earnings, and I think your colleague had it right that what's been driving the markets up so far this year is the confidence in those earnings. But let's put this into context. You know, we have the S&P 500 now with the highest weekly RSI in post-war history. Our own bull bear indicator got up very close to a sell signal at the back end of last week. Some of our own technical indicators are now getting stretched, and our technical analyst this morning described the S&P as having gone into no man's land in terms of parabolic territory. We've broken out to the upside. And I guess one final thing, global equity markets are up 7.25% already year to date. If we carry on going at this pace, you'd get to levels, for example, on the S&P that would be 6,000, 7,000. That's just not sustainable. So at some point, the market has to calm down.